Real average hourly earnings have fallen 3% since 2021. The 30-year fixed mortgage rate hovers near 7%. The personal savings rate has collapsed to 3.2%. The median home price is now 5.5 times the median annual income. The math is broken. This is not inflation. This is structural decay. Economists call it Dutch disease. It killed the Spanish Empire in the 17th century. It crushed British manufacturing in the 1970s. And since 1982, it has extracted $50 trillion from the American working class. It creates a paradox. A country gets so rich in one sector, it destroys all others. The U.S. did not find gold. We found financialization. We replaced the factory with the trading desk. In the process, we hollowed out the industrial core. This is not a recession. This is a pathology. 1959, the Netherlands. They find the Sloktrend gas field. Massive. Billions in revenue. The guilder, their currency, skyrocketed. Currency valuation spiked 30%. But watch the factories. Dutch manufacturing exports became too expensive for the world to buy. Foreign imports became cheap. The Dutch bought German cars and French wine. Their own industries withered. Unemployment exploded from 1.1% to 5.1%. Rich in gas, poor in everything else. That is the clinical definition. Now look at the United States. America's booming sector isn't gas. It is the fire sector, finance, insurance, real estate. In 1947, manufacturing was the heart of the beast. By 1991, finance surpassed manufacturing in GDP contribution. Today, it's a massacre. Look at the profits. This is the statistical anomaly. The financial sector contributes only 7 to 8% to the GDP. It builds nothing, it invents nothing, it just moves money. But it captures 25 to 30% of all corporate profits. Before the 2008 crash, it hit 40%. This is the parasite consuming the host. When 30% of the profit is in moving money, the talent follows. Engineers became quants. Physicists became algorithmic traders. We drained the brain of the industrial base, and then we exported the jobs. Between 2000 and 2010, the U.S. lost 5.7 million manufacturing jobs. That is not a market correction. That is an evacuation. 1/3 of the manufacturing workforce gone in 1 decade. Faster than the Great Depression. The narrative is technology took the jobs. Lie. Look at Germany. Look at Japan. High wages, high technology. Germany's manufacturing is 19% of their GDP. Japan is 20%. The United States, 10%. We didn't lose these jobs to robots. We sold them to finance the casino. How does the virus spread? 2 vectors. First, the reserve currency. The world needs dollars to trade oil, to buy debt, to save. This demand keeps the dollar artificially strong. It acts like a tax. A 10% stronger dollar kills export profits by 2.6%. If you make widgets in Ohio, you are fighting with one hand tied behind your back. If you are a banker in Manhattan, you are purchasing cheap imports with strong dollars. The strong dollar is a subsidy for Wall Street and a death sentence for Main Street. Vector 2, the buyback. This is the mutation. 1982, the SEC passes Rule 10b-18. Before this, companies buying their own stock was considered manipulation, illegal. After 1982, it became the business model. Why build a factory that takes 10 years to pay off? Just use the cash to buy your own stock. Price goes up, CEO gets a bonus, shareholders cheer. The balance sheet deteriorates. Let's look at the victims. Case 1, Intel, once the king of chips. They owned the silicon world. But between 2005 and 2020, Intel spent $108 billion on stock buybacks. Think about that number, $108 billion. That is more than their entire market cap today. They spent more on buying their own paper than they were worth. While they pumped the stock, TSMC in Taiwan built better factories. Now, America begs Taiwan for chips. Intel is on life support. Liquidation of long-term assets for short-term liquidity. Boeing, an engineering company run by accountants. Between 2013 and 2019, Boeing spent $43 billion on buybacks. They needed a new plane to replace the 737, a clean sheet design, but that costs money. That hurts quarterly earnings, so they didn't build it. They patched the old one. They added software fixes, MCAS. 2 planes fell out of the sky. 346 people died. The $43 billion they spent on the stock vaporized. The stock crashed anyway. This is the fatality of Dutch disease, financial efficiency over engineering reality. In 2024 alone, S&P 500 companies spent nearly $1.6 trillion on shareholder payouts. That is triple the income of the poorest 20% of American households combined. They aren't investing in the future, they're looting the present. So, the factories are gone, the chips are made in Taiwan, the planes are falling apart, but the stock market is at all-time highs. That brings us to you. The Gordon-Neary model of Dutch disease predicts one specific symptom, the spending effect. The booming sector drives up the cost of non-tradables, housing, services, healthcare, things you can't import from China. Let's check the vitals. 1985, median house price $82,800, median income $23,620, ratio 3.5x. You worked 3.5 years to buy a house. 2025, median house price $416,900, median income $83,150, ratio 5.0x. In coastal cities, it's 10x. The wealth generated by the financial sector bids up the price of land. They buy homes as assets. You need a home to live. You are competing against BlackRock. You will lose. Your wages are the other symptom. Since 1979, American productivity has doubled. You're working harder, you're more efficient, but real hourly wages for workers? Flat, stagnant for 40 years. Where did the money go? It went to the booming sector. The CEO to worker pay ratio in 1965 was 21 to 1. In 2024, it is 281 to 1. At Starbucks, it's 6,666 to 1. The median worker at Starbucks would have to start working in 4643 BC to earn what the CEO made in 2024. Stone Age labor, Space Age payouts. And who is keeping the patient alive? The Federal Reserve. When the resource, the financial bubble, threatens to pop, they print more. The Fed balance sheet, 2008, less than $1 trillion. 2022 peak, $8.97 trillion. This liquidity floods the system. It doesn't go to your wages, it goes to assets. It inflates the stock market. It inflates real estate. It creates the wealth effect for the holders of capital and the cost of living crisis for everyone else. They're treating the disease by injecting more of the virus. The symptoms are visible in the M2 money supply and the labor force participation rate, but the system will not self-correct. The cure requires $10 trillion in reindustrialization capital. Wall Street will not allocate it. The returns are too slow. The Federal Reserve will not print it. That causes hyperinflation. The system is designed to extract rather than rebuild. This leaves one trajectory. The booming sector continues to absorb capital until the underlying economy creates a sovereign debt crisis. We are currently at 122% debt to GDP. The breaking point is mathematically inevitable. In the next briefing, we analyze the timeline, the sovereign debt crisis of 2028, and why the reindustrialization of America will only happen after the dollar creates a floor.